Welcome to the Aramir Roundtable. My guest is Mike Chupka from Power Options. Welcome, Mike. Nice to have you on here.
Hello, Tom. It's great to be here. Thank you for the opportunity to speak with Aramir. And of course, I do apologize for missing the webinar in January, but glad I can be here today.
Well, jury duty has adverse effects to people's schedule, doesn't it?
Yeah.
Well, before we get going too far, just a normal disclosure that Aramir is not a broker, dealer, or investment advisor. This is for educational purposes only. Options and futures involve risk and are not suitable for all investors. Past performance is not indicative of future results. If you'd like to read the whole thing, just pause the video or go to the bottom of any of our web pages.
All right. Well, ladies and gentlemen, welcome. Today, Tom and I were discussing, we wanted to present to you some of the ideas here we found at Power Options for vertical spreads. What criteria are important for success? Of course, vertical spreads, we're talking about the credit spreads, bull puts and bear calls. And of course, the bear call credits, bear put debits, and bull call debits as well. Now, my name is Mike Chupka. I'm the Director of Education here at Power Options, and I've had the pleasure of working with Power Options and other investing groups for the past 17 years. I have co-authored 2 books on options investing, and I've edited a few others as well. And I've been trading options just as many of you, but I've been trading for 17 years since I started with Power Options. And Power Options, of course, is a patented suite of search and analysis tools designed for self-directed options investors. You know, there's a lot of tools out there, and you have several tools that are available with your broker, which we all need to trade. Now, how is our tool different? Well, on Power Options, you control the criteria and the settings to identify trades. So you know exactly why a trade came up in the search results or in the different signature tools that we offer. You can input the options criteria and various strategies to match your needs, the risk and reward tolerance, minimum net credit, deltas, probabilities, implied volatilities, and more. But at the same time in any strategy, you can also see the stock and technical fundamental criteria so you know exactly what to expect. And of course, we also offer various research tools, tools to run what-if scenarios, and powerful portfolio tools to not only track your positions as linked positions. So if I have 4 bull put credit spreads, 2 married puts, 3 collars, they're all shown as linked trades. So I don't see individual option legs that aren't linked to a stock or aren't linked to the option that's bought to create the small margin. But our portfolio tools also show you potential rollout opportunities in management where we do all the work for you, all the calculations that is, so you can get an idea of what you're gaining or maybe perhaps what you're limiting your losses to with any adjustments that's shown. Now, the search tool is a patented screener that we offer at Power Options. We support 23 of the most popular option strategies. And you can search all at once in any of those strategies for the stock and option needs, as well as looking at indexes, ETFs, if you want to look at weekly expirations, monthly expirations, quarterlies, and more. The strategies we support, of course, call buying, put buying screens, married call, married put, your buy rights, naked puts, cash secured puts, collars, covered calls, covered combinations, and all the various spreads, including our vertical spreads, straddles and strangles, condors, iron butterflies, and calendar spreads as well. Now, we may not offer all criteria that you use, but for the technical filters, you'll see things such as percent of 52-week range, stock volume, Bollinger Bands, historical volatility, RSI, simple moving average, MACD, and more. So you can specifically put in what you'd want to see for these filters, and the system looks across the universe of options, shows you only those stocks that would match that criteria. And for the fundamentals, the stock price filters, earnings per share growth, market cap, screening for stocks that have a dividend perhaps. Important, I feel, in this field is you can screen specifically for stocks that do or do not have an earnings date between now and expiration or ex-dividend date as well. Of course, if you just have a preferred stock list, you can create your own stock list and just screen against the 50, 60, or 20 stocks that you have in any of those given strategies with the option criteria. And speaking of which, what would be the option criteria? Well, of course, you can select the time frame. whether you want to do weeklies, whether you want to do standard monthlies. If you want to do linked positions, for example, calendars, I can force the position to go 90 to 150 days out for the leap or the long call that I'm buying and look to just sell weeklies against it to see the return. I can set the range for strikes in or out of the money. Of course, implied volatilities, implied volatility ranges, implied volatility over historical to see overvalued or undervalued options, return differences, and so forth. And of course, minimum net credit, probability, delta, open interest, and volume. So it's really a one-stop shop in all of those strategies so you can filter down to exactly what you want to see in any given strategy. What we've seen over the years in relation to criteria for bull put spreads and bear call spreads that we really need to focus on to be successful long term. And of course, you can be successful at spread trading. A lot of times it is, I don't want to say hit or miss, but anytime you set up a spread structure, we want to look for that good probability. We want that good leveraged return. But whenever we take a loss, we know we're giving up maybe 50% of the initial strike difference or margin requirement. Sometimes in a sudden event, we might lose the full margin requirement, might shoot through both strike prices. And it's hard to swallow because a normal spread with a good probability, you're looking at an 8-to-1, 9-to-1, maybe a 10-to-1 risk reward ratio. So it's kind of difficult to watch a month or 2 months of work disappear in one trade, and then you've got to get back to where you were. We can be successful, but we have to have realistic expectations. In the past 17 years, Tom, I'm sure you've experienced this as well. You get phone calls or a customer who's interested and said, hey, I want to trade credit spreads. Great way to use leverage. I looked at a position here on, let's say, Apple, and it's at 150, so I can sell the 148 and buy the 140, and I'm going to get a $3 credit for essentially a 42 to 43% return. Well, then you got to pause and say, well, you can get a 40% return, maybe even a 50% return on a credit spread, but long-term, we don't think you're going to be successful. So most of us who look for credit spreads, we want to be out of the money for that better probability of expiring worthless. On power options, we use the percent probability the stock will be above short put strike price in a bull put, for example, at expiration, or below the short call in a bear call credit spread. Now, most might want to consider starting off at about a 70% probability or higher that the trade would expire worthless. This roughly translates to a short option delta of 0.30 or less. And of course, at the same time, well, if I'm doing a bull put spread, I want to look for a stock that's showing me good criteria of being a neutral to bullish structure. Or a bear call spread, I want to see something that's trending downwards or has a bearish trend. Now, expectations. I run a search on power options, looking specifically for bull put credit spreads with a 70 to 75% probability. The top 3 results going maybe 1 month out in time. We see a few trades here. And let me just see, can I do this here? 1 second, folks. I'm just learning Zoom as we're going along. Let me try this here.
You do like the annotation tool?
Yeah, okay, that's not quite what I wanted. But here we see that the average return in the 70 to 75% range is about 36%. And of course, our probabilities here, 71, 73, somewhere in that range. Okay, I'm going to try to do a different tool later on. So let's assume we're right. We've got our 70% probability. So we're going to look to be right 7 out of 10 times. Our average probability here is 72.3%. And the average return is 36%. Now, we look at the strikes here. Most of these are 2.5 strike difference trades. So it's only a 3-to-1 to 4-to-1 risk-reward ratio. And if we assume we only take a 75% loss, not the full 100, but a 75% loss, would we be successful long-term? Okay, hold on, folks. I'm sorry. Well, another source that we offer is radioactive trading. I won't go into that now, but at radioactivetrading.com, we've got this little simulator tool. And it's under the resources tab at Radioactive Trading. Now, what it allows us to do is input a plan, sort of a trading plan. So if I input an expected target of 36% return on what I invest. And I limit my losses to 75%. And I assume this probability of loss here of only 30%, meaning 70% probability of success. We start out with $10,000 to invest in spreads, and we only allocate, let's say, a third to each position. Over time, we could be successful. Of course, this simulation shows a 67% return. What the tool did when we hit submit is it flipped a coin 100 times. Heads, we win, we make the 36%. Tails, we lose and take that average of about 75%. We set our probability to only a 30% loss, a 70% win, and here we see we get the win ratio that we want. But what's important to notice is the wild swings. And when we look at the wild swings here over time, sorry, folks, we may see a drawdown of almost 87, 88%, down to 1326. Of course, we almost tripled our investment at one point as well. But long-term, this was profitable. Now, remember, we were looking at spreads that are about a 1 month out in time. We were talking about allocating $10,000 and allocating 33% to each trade. So we did 3 trades per month, 36 trades per year. So to get to 100 trades, it'd be 3 years. So the average is about 22.2% per year. That's not bad at all. But that's what we may want to consider as a target for expectation. Now things get tricky. In that probability range, we need 73% to win. Using the same numbers, but if we are right only 66% of the time, you see those wild swings again, where at one point, over the 100 trades, we had a high value of about 13,300. Still 33% gain, very respectable. But it ended up with a drawdown to $834. And over 100 trades, we might be looking at a 90% loss. Long-term outcome is we may be near bankrupt for the funds we allocated to this portion of our portfolio. Now, running this scenario several times, 36% return, drawdown of 75% max on the position, you're not even profitable if you're right 70, 71% of the time. At 72%, you're a little bit above or a little bit below break even, depending on the scenarios of winners and losers in a row. You have to be right 73% of the time just to profit. And if you are more than that, well, you'd exceed that level. But remember, you were looking for a probability with an average of 72.3%. If you're just below that, you don't make a profit. And that's the nature of spread trades. But of course, this is just sort of an introduction to get a benchmark. I'm sure already the wheels are turning in your mind saying, well, you've missed several things. What needs to change? Well, you're right. A few things need to change. Trades can be managed. Trade starts to go against me if it goes against me in a reasonable time frame, meaning that I was 3%, 4% out of the money for a weekly spread, or 7% or 8% for a monthly, and the stock starts to fall down gradually, hits a trigger, I'm able to manage it. And we also teach 8 ways that you might manage a bull put credit spread or bear call credit spread. But the losses should be lower than 75%. Why did I use that? Because looking over the last year, when we saw those sudden drawdowns, February 5th to February 9th in 2018, March 21st to April 5th, October, first few weeks of November, and then again in December, those snaps happened so quickly if you were in a bull put credit spread that you were near a 65, 75, sometimes a 90% loss on the spread, even though it was out of the money the night before. Market opens a few hundred points down, you're already below your first strike price and approaching going below the second strike price as well. So what else needs to change? Well, we can increase probability. That's going to lower the return, but give us more cushion, allow us to be further out of the money. And of course, position sizing is also very important again. Let's take that same search that we ran a moment ago with a 70 to 75% probability, but increase it to 80 to 85%. We see similar stocks in this situation, similar strike differences, 2-point spreads, 2.5-point spreads, 5-point spreads. Now, the average return, naturally, if I'm looking for that higher probability, is going to drop down to about 19%. This is still for a 30-day trade, remember. But here's our probability in that 80 to 85% range, an average probability of 81.8%. So we're further out of the money. Still have a good, reasonable leveraged return. 19% average return, 5-to-1 risk-reward ratio on our investment. So we can assume that if we take a loss, we're not going to take 75. We might only take a 65% loss or less. How would that turn out with the same type? Sorry, folks, I'm just trying to, oh, there you go. That's what I wanted to do. My apologies. All right. Run that same scenario. 19% target return. Loss limit of 65, but remember now our probability of losing is only 20%. Take the same $10,000 investment, allocating 1/3 to each spread. Now, we don't see as high as a profit in this scenario, but what are the two things that we do notice? At one point, we might have doubled our money and had a high value of about $23,000 or so. The low point only had a drawdown of 33%. And that's still extraordinarily high of what we would consider in a portfolio for a strategy we're hoping to win on. But again, it's not an 80% drawdown. It's not an 85 that we saw with the other probabilities. Now, this win rate is only about 3%, not very respectable, but it's at the target. Remember, we were looking for about an 80 to 85% probability. In reality, the average was about 82, 81.8%. So we're at the target to be successful. Whereas with looking at the 72.3%, we had to be right 73% of the time or more to get the target profit we expected. So where do we hit the goals? In theory, right at the mark. In this simulation, we're right 82% of the time. 18 losses out of 100 trades. We almost take the high value at one point up to 44,000. We will have a drawdown. It's going to be a leveraged drawdown, and we have to remember it works both ways, but it's not 65, 75, 80%. It's only about 30%. And again, we're seeing an 89% return perhaps over the course of a 3-year period, which would average out to 29.9%. Same scenario, remember, 3 trades, looking at a monthly expectation, average return with the probability we were looking for, 36 trades per year over 3 years, ending amount to about 89% with an 82% success rate. Okay. Now, this is why we walk through that, is because I think this is reasonable and this should be the benchmark. For credit spreads, whether you're doing weekly, whether you're doing monthly, 25 to 35% per year should be the expectation. Some years you're going to have a higher return. I did see a higher return with my bull puts in 2016 and 2017. 2018 was more in this target range, even with February, that March 21st to April 5th decline, and further. Now, trades can be managed. Losses are going to occur, and they're going to be large at some times. But is it likely to hit this expectation? And could we have done it in 2018? And as I mentioned, we look back. Many of us might not want to look back at 2018, considering the good 1.5 month return, maybe for the bulls that we've seen in 2019. But over the year, 6 out of the 12 months were negative performance. Now, it kind of implies a 50% win-loss ratio if you're just doing at the money, buying calls, buying puts, or doing slightly just out of the money bull or bear spreads. And the problem is with the losses, they happen steeply. The February 5th to February 9th, that sort of volatility collapse that we saw there, that was damaging. I know I was in 3 bull put credit spreads here, and 2 of them hit an 85% loss on the second day before they could be managed. This was the first discussion of trade wars with China, March 25th to April 5th. End of June had a little one, and then the October surprise. and steep decline. And then again in November, and of course we remember December, but you could recover by the end depending on how far behind you were. So the steep losses hit, and remember when we win, we're winning 15%, 16%, 19% of the leverage, but then we lose, we might be taking that 6-to-1, 9-to-1 risk-reward ratio. And that's what we experienced. So could you be successful with spread trades during this year? And one of the interesting things we found is that yes, and it actually was in the bull put credit spreads, not the bear call credit spreads. A bull put approach could have seen a 50% return in 2018 using a shorter term 2-week out trades. And we had an 88% success rate. So 74 trades over the course of the year, 65 wins and 9 losses. Now the average winner was 15.1% on the winners. That 19% we were looking for was for 30 days. So even cutting it in half still kept us with an average win of 15%. And we did take an 88% average on the losses because of those sudden movements. That was higher than that. Now, this is not the results of a trade recommendation service or something that we offer at Power Options where we post the trades for you. We talked about the search tools on Power Options, how you can set up your own screen and have all the tools available to match your goals and your specific needs. We do put together default criteria for you to use as a stepping stone to create your own search. And a lot of this is based on my experience, Ernie's and Renner's experience trading positions. And as you can tell, I go back and test these every year to see how they performed over 3, 5, and over just the last year, and even just a 6-month period to make any subtle adjustments that might be necessary. In the bull put credit spread search, we have a bull put weekly default screen. And this is the trading results if it was started on January 1st, 2018 through December 29th. It was a 50% return. Now I have an asterisk next to that, and there's a reason why. I traded most of these, but I actually stopped trading them in October. But the track record does kind of go through October and November and December. I took my losses in October, and I decided not to trade bull puts for the remaining 2 months is what happened. So here's what we did. Using a different tool we have with our historical data on Power Options, which we record ourselves at the close of every day, and it goes back to April of 2006. I took an account of $100,000, took the top 3 results every 2 weeks, Monday following the expiration. I calculated to expiration with no stops or management, but the key to spread trades, and we're going to show this in a moment, is that we only allocate 6.6% of the total portfolio to each trade. So when I'm doing 3 trades, I'm making sure that the total invested in my portfolio is 20% or less. Sometimes only 2 trades were open depending on the criteria and what was available in the universe of options. We highly suggest that when you're using spread trades, it shouldn't be more than 15 to 20% of your total account, and I'll show you why in just a minute. But with this structure, we took the bull put weekly, and on December 29th, the ending amount was $109,986. And you could say, wait, that's only a 10% return. And you're right, over the full portfolio, but we only allocated $20,000 to the spread trades in this portion of our portfolio. So we could say that the 9,986 is 49% of the 20,000 that was allocated to the position. Shouldn't surprise us, even with February 5th through 9th, but the highest mark during this trading was on October 1st, where the portfolio was at 125,385. We're not including other strategies in this portfolio. We're just saying if we had 100,000, we took 20% of it and allocated it to 3 spreads each cycle, how would it have performed? Well, we had a 25.4% return on October 1st before that 2.5-month craziness we experienced at the end of 2018. But remember, we only started with 20,000 allocated to the strategy. So we made 25,000 on the 20,000, so we could look at it that way. The lowest mark actually occurred not at the end or the middle of December after the 3 months of decline because it had built up so high for October, which is what we wanted to see. The lowest mark naturally was after the first steep decline, February 20th. where it was down about 8%. Or, of course, work it both ways. Well, we're down about $8,000. I had 20,000 allocated to it, so I'm really losing at about 40%. Okay, now why only 20% or less? This is one of the reasons why. You can see expected returns that match your goals for the amount invested. And we can structure it in the sense that we will see drawdowns, but to keep it controlled. But if I invested more than that, comparing it to other structures we could use for the bull puts, we would have larger losses, those wild swings we saw earlier. Now, this is the default search we offer on power options and bull put credit spreads, the bull put weekly spreads. We're looking to be between 8 and 17 days out in time when we open a screen, that 2-week out range. We want a net credit of greater than 20%. Let's see if I can do this. Nope, that didn't work. Oh, okay, hold on. So that's what I needed to do. There we go. So we're looking for net credit of 20 cents, but still that would give us that average of 15 to 17% against the margin. We want to be a reasonable range out of the money, but of course, that probability of greater than 85%. And I do want strikes that are greater than 2 points apart, and we'll see why. But in addition to that, not just the structure we look for, based on what the simulation would show us, and based on what we've done before with analyzing these different searches and historical track records over time, I also want stocks in an uptrend. I want to see stocks that are moving upwards, that are above their 20-day moving average, and have a positive MACD crossover. And as always, I want to avoid earnings between now and expiration. And that's what I'm able to do with the Power Options tools. And of course, this default screen is already set up for Power Options subscribers to use as a stepping stone to make any adjustments they want. So the results, again, of that specific screening filter is taking into account the stock criteria I'd want for a bullish structure with the reasonable option criteria that seem to work better and hit my targets. We had an 88% success rate over 74 trades in that 1-year period, average 15.1% gain on the winners, and the 88% average on the losers. Why is that important? Okay. From John. John says, still only seeing the slides. Sounds like he's showing the tool. Let me go back. I wasn't showing the tool. I'm showing a screenshot of the criteria that were being used, John. Okay, this is, you're seeing the slide now with just the criteria that were there. I wasn't showing the tool. I was just showing the slide. And I was trying to check off what was being used as the active filter for the bull put weekly. We may get into the tool a little bit later on, but right now we just wanted to discuss the results of the criteria and what did and did not work as well. Okay, so that was this screen here I was showing, John. Let's move on. Now we talked about the results again. Okay, John says, no, I'm seeing believe it or not slide. I don't think it's paused. Let me see here.
I'm seeing end results.
Okay, end results just popped up. And then did you see I used this as a benchmark when we discussed the criteria?
Mm-hmm.
Okay, so, excuse me, folks. John, I'm not sure how it works with Zoom, but your signal might have locked up. Tom's saying he's seeing the screens move and he's seeing the slides move. We're looking at one called I use this as a benchmark, and here's the default weekly screen.
Yeah, it looks synced up perfectly. So okay. It could be maybe a lagging issue for John. All right, great.
All right, he's going to try to refresh. Fantastic. Yep. Okay. So, well, I'm showing you one thing, and I'm not trying to, lack of a better term, force it down everyone's throat, because I want to see what would happen. Same criteria, but different structures. Let's take that same expiration time frame, 8 to 17 days out. Same stock settings, above the 20-day moving average, no earnings between now and expiration, MACD positive crossover as well, and the same allocation, $100,000 taking less than 20% of that allocated to spreads, and look for the spreads that had that maybe 33% return range instead of 15. Let's try to double the return which would put us in the 70 to 75% probability range. The trades that matched those criteria over the same time frame at December 29th, the $100,000 portfolio was down to 82,747. So we're at a loss of 17.3%. Whereas same stock criteria looking for that 85% probability or higher, we were at a gain. So it's a 17.3% loss on our portfolio, or what we might consider as an 86.3% drawdown of the 20,000 we invested. That's not where we want to be. We did have a high mark, very similar to what we saw with the other ones, but a month before. 112,350, so 12.4% or 61.8% of what we invested. Here's the trade-off. Even with the limited allocation of only 20%, the lowest mark occurred on August 20th. It's kind of interesting considering that the big drawdowns was that June series and then October and November. But the lowest mark was 67,000. This is a 32% drop. But remember, I had only taken 20,000 to allocate to spreads. Here we're seeing a loss of 32,000, which means what? I would have had to borrow from other strategies in my portfolio in order to continue trading to hope that I got back to break even, and I didn't. I cut the loss in half over the next 6 months, down from 32,000, I'm sorry, 4 months, down from a loss of 32% to only 17%, but it never got back. And I would have had to borrow money in order to stay with the strategy. So if I had invested 50% of my portfolio to spreads, I probably would have been down 60 to 70% that we saw in the simulation before, maybe more because of that lie of leverage. How can it be so much worse if we're doubling the return? Well, the average return on the positive trade was 31%, double the 15%. But the average on the losses was 94%. Now, why is it so high? Even with stops, those declines we saw were too fast. And the spread was close to an 89, 95% loss the day the market opened with that steep decline. Spreads were already at the high loss. It did have a win ratio of 73%. That's close to that target we looked at earlier. 70 to 75% probability, need to be right 73% of the time. 52 wins and 19 losses. Well, we have to control that 94%. So we ran that same scenario, 70 to 75% probability over the 12-month period, but using a stop if the stock hit the short put strike price. And it cut down the losers. The average on the losses dropped to 68%, 68.4%, I believe it was, when we had a loss, but it also canceled out some of the winners. So now we only had a 66% win ratio, and we saw how terrible that was on the simulation. The stop did not help us as much as we'd expect over the course of that 12-month period. And again, we see why. Remember, if I'm taking a 70 to 75% probability, I'm still out of the money, but I might only be 3-4% out of the money on those positions, still 2 weeks out in time, still looking at an average of about a 31% return. But the stops were not effective because the declines were so steep and so sudden. And on February 5th, in this scenario, the 2 to 3 trades that were open had a loss of 98.9% at the open the next day because we weren't as far out of the money. We didn't have as good enough of a cushion. So that wiped out all successes in January and probably put us 4 to 5 months behind. Then we saw it again, of course, in October. That first open on October 8th or 9th, 2 trades that were open at that point hit about a 97% loss before you could do anything. And then it didn't recover. Maybe you could have converted it to a bearish spread and been successful, but then you got whipsawed in the next 2 months. Well, next 20 days or so. Now, it wasn't as bad as March, but the losses were still 60%. So this is why I felt there may be a sweet spot, because I've done this same testing with this criteria. We did it from 2015 to 2000. Presented for this year to show what would have happened in 2018. Okay, We see the structure we want, we know the win ratio we need, and we've seen that why looking for double the return, almost double the delta, but with just a probability of 70-75%, would not have been successful, even potentially with management and stops in place. And that sort of trading year, which was very different from what we saw in 2016 and 2017. But now that we know what spreads, and you already probably knew most of this anyway, I know you're all advanced traders, many of you probably already figured that, yeah, of course, Mike, I want to look for something that has a good probability, and I think a double-digit return, 10, 12, 15%, is the reasonable target for a spread. I already know this. So I can look for spreads that have that lower short delta I want or the probability, and I'll be successful. All right, well, let's take that winning bull put spread criteria on the options itself. Minimum 20-cent net credit, 85% probability, average return of around 14 or 15% that we were looking for 14 days out in time. Same allocation. Let's take out all the stock criteria. I'm not going to look for stocks that are trading in an uptrend. I'm not going to look for stocks with that positive MACD crossover, and I'm not going to care if we have earnings coming up or not. What do you think is going to happen? Well, same year, same allocation, ignoring the stock criteria, the $100,000 account dropped down to $70,844. Loss of $29,000. $9,000 above the $20,000 we would have allocated, $15,000 to $20,000 we would have allocated. The win rate was still 76% over the course of 78 trades. So if we had a target win ratio we'd want, why weren't we successful? Because we were looking at the 80 to 85%, the 85% probability or better. We need to be right 82% of the time. We're not near it. So the loss is down about 30%. And the highest mark, again, similar to what we saw with the 70 to 75% probability range, was on January 29th, a 9.3% gain or 46%. It's respectable for first month of trading. But long-term, ignoring the stock criteria, even with the winning criteria we saw for probability and more, put us in a loss. We have to have the combination of both, and that's why the power options tools are so important, because you can screen for both in any strategy at the same time. The stock criteria is important with the option criteria. I can't just expect to go out and look for bull puts or bear calls with an 85% probability, 8% out of the money, and say, hey, this is going to be good. You might have winning trades. But long term, if you don't use that criteria with the trend, this is what you'd expect to see. And I'm sure many of you already know that, and this is maybe review for many of you. But I wanted to show you the importance of what could happen with trying to look for more positions by ignoring stock criteria and just using what you want for the spread, or just looking for stocks and not using the right structure for the spread with the probability rates and the delta rates that seem to work best long term. So let's review all the numbers. With the right stock criteria, the 85% probability with the stock trend was a winning track record, near the reasonable expectations of what we'd want to see for a credit spread portion of our portfolio. Looking between 70 to 75%, doubling the return, with even the stock trend loses. Even with putting in a stop, if the stock hit the short put strike price or the stock dropped below the 20-day moving average and changed direction, it still ended up being a loss, just not as big. The 85% probability with no stock trend also lost, and significantly, 29-30% downdraft at the end, where we might have thought in the first month we had a successful track record. Now, the best one was using what we saw, the 85% probability with the stock trend in place and putting a stop at the put strike price. The ending amount would have been about $5,000 higher than what we saw at 114 over the course of the 12-month period. This would have been a 14.8% gain. On the 100,000, but on the 20 we allocated, 14,800 is 74% of 20,000. Interestingly enough, it ended up with an 83% win ratio instead of 88. And I think this is really important. I'm not sure if Dan and Amy teach this, and if they do, there's nothing wrong with it. But I've seen a lot of customers, Power Options customers, have been asking me on webinars recently, within the past 5 months, if I'm doing credit spreads, should I stop the position when I hit 50% of what I expected to make? We open a 2-point spread for next week or 2 weeks out in time. We get a 20-cent net credit on a 2-point spread. This is around 11.1% return. And the idea is when you've made 50% of what you expected to make, when you can liquidate the spread for a 10-cent net credit, you should go ahead and do that. What I have found, I don't have a slide for this, I'm just going to talk very quickly. What I have found in my personal testing is that if I closed all of the spreads, let me rephrase that. If I had put in a stop to close any of the spreads over the course of this 1-year period, where I had a 50% profit on the position, the idea behind it is you increase the win ratio, because positions that would have lost later on, you closed out early and made 50%. But then you also close all the winners out for only 50%, not the full 11, 12, or 15% target you might be looking for. My experience with that is that the spreads that lost usually lost right away. The 12% losers, we had an 88% success rate. The 12% of positions that lost never hit that 50% win ratio. They were at a loss beforehand, and where you had to manage it, where you'd hit the stop before it got to the 50% profit. So what ends up happening? You still take the losers on the 12%, with the average of about a 50% loss ratio here with the stop in place. And positions that would have recovered later, you only get half of the profit. And on most, you're only getting half of the profit. And some of them were closed earlier with the stop, of course. So instead of seeing a track record with an average of a 15% winner, or in this case, 14.8%, 15% average win, the average win in that scenario, with trying to force it to close when you have a 50% profit, the average return was only 6.8%. I'm only right 83% of the time. What happens there? In the simulation, that doesn't work long term. If I only make 6.8% when I'm right, and I lose 50% when I'm wrong, I need to be right 92 to 93% of the time to profit long term. So I've never seen in my personal portfolio or in my personal trades that this closing a spread when you've reached the 50% profit really enhances the winners more or enhances the portfolio more. And I'd love to hear Amy and Dan's conversation on that, if they're using that in their portfolios as well sometime, because I have not seen it work to my benefit.
Hey, Mike, I had a question. Just I know there's kind of a general opinion that you should close spreads out when they get cheap. So if you're selling something, have you tested it if it gets down to like a dime and 20 cents, something like that?
80% is my target, Tom.
Okay.
And what I know we're throwing a lot of numbers about probability and percent, but if I sold it for a 20-cent net credit, let's keep it simple, Tom. If I sold it for $1 net credit, if I can buy it back for 20 or 15 cents and I still have 4 to 5 days to go to expiration, I might close that spread early. If I'm within 2 days to expiration and it hits, I'm probably just going to leave it open to try to take the full 100%. If something happens, one of the stocks I've been watching that's moved up about 13% in the last 5 days, T-Rex. They do that fabricated building for decking and outdoor materials. Yeah, I think they're up about 13, 14% in the last 5 or 6 days. If I'd opened a bull put spread, for a 2-week or 1 month out expiration 5 or 6 days ago, I probably could have closed it yesterday, less than halfway into the trade or less than a fourth in the trade if it was a monthly spread, and made 80%. And I absolutely would have done that.
Oh, sure.
So cheaply, I agree with 10 cents. If you took in, let's say 50 to 60 cents, you close it for 10 cents, 5 cents. Absolutely. If you're on the day of expiration and it hits 5 cents, 10 cents, I might just leave it open. It's hard to gauge because where am I in strike difference relation in the next 5 hours? How far could it drop? I just haven't seen that this 50% idea works in my favor.
Okay, I'm just curious what testing you've done along those lines.
It improved this slightly, but not dramatically with the 80%.
Mm-hmm.
And as I mentioned, when I did do the testing with the 80% rule, in my opinion, the cheap buyback cost, a lot of them happened within a day or two to expiration, and I would have just left them open for the full profit. I probably closed maybe 8. It was 8 spreads early for the full profit, and then used that margin to get into a new position.
Sounds good.
So it would have increased what we were looking at before, the win ratio of 88%. It would have bumped it up slightly to about 90. And it was 8 trades that were able to close earlier. And it dropped the average return from about 15.4 to about 14.6. I'm trying to go through my notes here that I have in front of me. It's a 14.6, I think is what I have. So it had an effect on both. Lowered the return slightly, increased the winners slightly, increased the overall profit slightly, but it wasn't dramatic. Even with the 80%, it wasn't a dramatic change. Where I saw the dramatic change was if I tried to force to close it for 50% profit.
Right.
Because it didn't work in my favor.
Makes sense.
All right. So, and I'm sure another question came in. You saw the criteria that we used, and I had that one thing where I was forcing the spread to be 8 to 14 days out in time, and I was looking for a strike differences greater than 2. It could be 5, they could be 10, they could be more, but on average, it's about 2, 2.5, and some 5-point spreads. Every test I've run through 2015 to 2017, and 2018, the shorter term, smaller margin trades were not profitable. And I think Dan might agree with this because from what I saw in his presentation that was posted yesterday for the weekly playbook, where he shared his spreads that he was doing from October to December, I believe. Dan Harvey, of course, the weekly playbook there at Aramir. He said he was using wide spreads. And I can't remember if they were 5 points, and some of them were maybe 4 points, and some of them I think were 7 points on some of the examples he posted. So the natural thing to think is, look, if you're successful going 1 month out, as we all know, the real concept of options is if I sell shorter term, if I'm able to sell week by week by week, I get a better annualized return. Well, the problem is with spreads, if I look shorter term, if I go 5 days out in time, the average credit for a good probability that matches our target is about 8 or 9 cents. And you're only 1 or 2 points out of the money for that shorter term. So if there is a hiccup, before you know it, you're almost below both strike prices in the shorter term trades. You're not going to experience a hiccup like we saw. We saw it 6 out of 12 months last year were significant enough to blow through both on a weekly spread. But you only took in 8 or 9 cents. I take a 2 point, and that's for a 2 point spread on average. I apologize. So it's 8 or 9 cents for a 2 point spread. If I take a full loss of 2 points or 80% of that full loss, I just wiped out almost 20 previous trades. That could be as much as 1 month to 2 months of profits are gone in an instant. And it's not just one trade that would do that. If I had 3 trades open, I would take almost a 2 point loss on all 3 trades, wiping out maybe 3 months of previous work. So I didn't find that to be successful. And you say, well, spreads give us this great idea to manage the leverage. And if you're allocating X amount into 2 or 5 point spreads, you could diversify and open 6 or 7 trades and just do 1 point spreads. Sell a 55 and buy a 54 on a bull put. Well, the 1 point spreads, even 2 weeks out, the average credit is close. It's about 7 cents. But with only 1 point apart, when the stocks fluctuate, you tend to hit that full loss more quickly. So even if you diversified and did 6 trades that were only 1 point apart, I saw a losing track record over the course of the year. It did not perform. That's why I look for the 2 point spreads or more. I think Dan would agree with that because his weekly playbook, if I read it correctly, I watched the webinar correctly, he was looking for wider spreads as well. The 1-point spreads you can do with a smaller account. You don't have that much to allocate. But remember, in spread positions, any portion of your portfolio, it shouldn't be more than 15 to 20% of your total portfolio because of the wild swings that we saw. Even looking for the right probability, any sudden market movement, if you're allocating 30 or 40% of your portfolio, you can watch that disappear in an instant. And then how long would it take you to get back to break even if you're only starting off again from scratch with 60% of what you started with? It's going to take you a long time, even with the leverage positions. So that was our target. That's why we have the Bull Put Weekly default searches there for you to use as a stepping stone. We have other default searches that you can use, but the whole point and the power of the Power Options tools is that you can put in specifically what you want to see for your spread, your risk tolerance, your strategy, whether you want to do calendars or collars, and you can combine the stock and the option criteria all at once. You know exactly why you're seeing the results that you're seeing, and you have the advantage to further fine-tune that to find the best trades. What I showed you today was an example of what we have seen work for us over the past several years in this particular strategy. With the market the way it was in 2018, believe it or not, it was a struggle to find a successful bear call credit spread performance. Because even though there were sudden declines 6 out of the 12 months of the year, the remaining 6 out of the 12 months showed gradual, if not relatively steep increases. So you were having more losses on the bear call side, even though in small windows, you'd have that very high success. Maybe a straddle position, long straddle or a long strangle would have been more profitable over the course of 2018, the way the market was as well. An interesting question just came in, Tom, that I want to handle. It's from Manuel. And he says, do you move on to different equities every month? Or do you consider trading the same security in sequential months with expectations that return to the mean to might help overall performance? Asking for a friend, wink, wink. Personally, I move to different equities every month. It's not every month. It's with this portion of my portfolio, the bull puts. When I hit that expiration, when it was 14 days out of way, Monday afternoon, 2 or 3 o'clock in the afternoon, maybe even in the morning, I'll run that bull put weekly search again. If similar stocks that I traded from the prior expiration series come up again, I will trade them. If they don't, I move on to different equities. I don't have the numbers for me. I will get it for you guys and I'll send it to Tom where he can post it, or I can comment underneath maybe the webinar, this webinar here when it's archived on Airmere.
Sure.
I did run a scenario for a customer of mine in the last month. He had a very similar question, probably not the stock that Manuel's asking about. But I did bull puts on SPY, looking for an 85% probability and a 75% probability or higher, 85% probability or higher over the same 12-month period. One was successful, one was a loss, keeping the same stock. I didn't do it with Apple. I didn't do it with Netflix. I didn't do it with Google yet. I'll say yet. My preference personally is to follow the search criteria that worked and not get married to a stock. When I get married to a stock in another portion of my portfolio, I'm using married put concept that we teach at Radioactive Trading, about 40 to 50%. But for the bull puts, for the credit spreads, that 15 to 20%, I'm switching expiration to expiration based on what comes up in the search results on Power Options for the screens that I use.
Well, thanks, Mike. I really appreciate you coming on and answering questions and sharing your research. It's really always good to have you here. We look forward to having you back in the future.
Tom, thank you very much. I appreciate the opportunity to speak here, and I look forward to continuing on to see Dan's and Amy's research on what they're doing as well with the weekly playbook I looked at last week. I give him a little bit of props. The strategy that we showed today, what I've been using, I mentioned that I personally stopped trading the bull put spreads in October, but we did go out in the historical testing, of course, and show how it would have performed. I believe Dan's, I can't remember the exact numbers, but I think he had a 91 or 92% win ratio on his spreads that he was showing the other day from October to December. And I don't know about him, but both of us, I think, have probably had a 100% success rate in the first 2 months of 2019. using what I use for the Bullput Weekly and what he's using as well. But I'm just saying that he did beat me from October to December if I was trading these continuously, his performance versus mine.
Dan's pretty good. So.
Yes, he is. Yes, he is. No doubt about it.
All right. Well, thanks, Mike. Thanks, everyone. And I will get this posted as soon as I can.
All right, Tom, thank you very much. Thank you, everyone. Have a fantastic week, and I hope to hear from you soon.
Thanks. Bye-bye.